A 12% dividend paid out monthly sounds too good to be true, right? No, it's actually a real thing, and it's been a part of my portfolio for the past couple months, and I keep buying. Today we're going to be talking about QYLD and its two cousins, which some other people may prefer. Talk about what you need to know about a 12% dividend stock, some of the pros and cons behind owning a stock like this. I'm going to talk about how I plan to maximize my profit having a weird type of dividend stock like this in my portfolio. I'm going to talk about how much weighting I give it in my overall portfolio, because this is not something that you build your entire portfolio around. We're going to talk about some of the quirks about owning a dividend stock like this and why it's not something that I plan to build wealth with for the long term, more for the short term. And then finally, we're going to talk about the taxes, because taxes on dividends are something that I think need to be talked about. They are something that a lot of people don't want to think about when it comes to long-term investing. People know that if you hold for longer than a year, there are tax benefits. But there are different types of dividends. They're not all viewed the same based on the criteria that the IRS gives out. And this dividend stock pays it out in a pretty unique way, so I wanted to talk about that. Today we're going to be talking about QYLD. QYLD is a relatively new stock, and when you look at it, the price history doesn't look super attractive. In the past 6 months, it's down 12%. In the past 1 year, it's down 11.74%. In the past 5 years, it's down 12.84%. So you might be looking at me thinking, why would someone want to own a stock like this? And the reason that I've added it to my portfolio is the reason that it pays out its 12% dividend monthly is that it sells covered calls on the NASDAQ. So the QQQ is one of the common ETFs that follows the overall NASDAQ. NASDAQ is going to be the tech-heavy index. It's going to be the 100 largest tech stocks. For the past decade or so, tech has been the place to invest. It's seen the best returns, but as the stock market has decided to sell off in the past, 3 or 4 months, tech has been the hardest hit place. And with covered calls, the way that the premiums are going to be paid out is based on volatility. Volatility increases when the stock market goes down. That's just kind of the general way to think about it. So if you ever see a day where the stock market is up and volatility also goes up, that's something where you really need to look to see what's going on. But for the most part, as the market goes down, volatility goes up. And as the ETF is selling these covered calls, the premiums are going to go up. So while this is a 12% dividend right now, it likely won't stay that way for the long term. Likely it's going to dip down to around 8%. An 8% dividend paid out monthly is pretty unique in the overall stock market. So you need to talk about what some of the cons are. We've talked about the pro of a monthly dividend paid out that has a 12% annual yield. Let's talk about some of the cons. The cons has to do with the overall strategy. This isn't something where if you could just throw your money into this stock and make 12% a year, you wouldn't need to buy the overall market if on average the stock market's returning 10% a year, because you could just outperform it by buying QYLD. The downside is that covered calls, the way that you are pocketing that premium is that you're limiting your upside potential. You don't need to really understand how options work, but basically a covered call is someone is paying you money for the ability to buy shares that you currently own at a given price at a certain time. This is all done behind the scenes. You can go in and for individual stocks, and even for QYLD, you can sell covered calls based on the stock. You just need to own 100 shares of the stock, or if you want to have a naked covered call, which is a huge discussion where it has unlimited risk and we don't like doing that. But it limits your upside potential, because the more premiums you're going to be making is closer to the current strike price. So this limits your upside potential. So if the NASDAQ skyrockets tomorrow, you're still going to be bringing in that premium from selling that option that was done behind the scenes, but unfortunately you're not going to be taking advantage of the huge rise in price that the NASDAQ has seen. So when is this type of stock going to do the best? Honestly, it's right now. This type of stock, a covered call ETF on an index or the overall market, is going to do the best as the stock market goes sideways or down slightly. If you think that the stock market is going to collapse, there are other ways that you can hedge against your portfolio. One of the ways I've done that in the past is with an ETF called SQQQ, which is a triple leveraged inverse ETF. So if the NASDAQ goes down 1%, this stock is going to go up 3%. The problem with that is decay. Those ETFs are not meant to be held for the long term. So as the stock market has gone sideways, we haven't seen a major crash. We've seen a spike in volatility. We've seen the market go down a pretty significant margin, but it hasn't been in a huge crashing motion. There hasn't been a catalyst that has set off the overall market. So we're bringing in 1% premium as a stock market. The NASDAQ is down around 12%. So as the market recovers, this is not going to be a great long-term play, but as the stock market goes sideways or goes down slightly, this is a great option for me to be able to continue to buy shares of a stock that is going to hedge against my portfolio. So now we're going to go into talking about how I decide how much of my portfolio I want into a stock like this, because as I mentioned, this is not something that you build your overall portfolio on, because there's a lot of risk associated with it. You're selling covered calls, so you're limiting your upside potential, which is something I've been an advocate against in the past. But as the stock market goes sideways or down, we're in a good spot. So what percentage of my portfolio do I have in QYLD currently? Right now it's sitting around 5 to 10% depending on the week. I'm going to be buying more QYLD this week, but I think that's a good level to have because dividend stocks do the best as the market kind of chugs along going to the upside or goes relatively flat because those dividends are still going to be paid out no matter what the stock price does. So that gives me the positive where if the market does turn around, I have the upside potential of that 90% of my portfolio and the dividends paid along with it. But if the stock market goes down, I'm hedging my portfolio slightly and it's not going to be as bad as if I was 100% bullish on the overall market. When you look at QYLD, there are some other options. If you don't want to invest into something that's following the NASDAQ, there's going to be XYLD, which is going to be following the S&P 500. There's RYLD, which is the Russell 2000. For those of you that don't know, the Russell 2000 is the small cap stock index. And so there's 2,000 stocks, and this is a very interesting place to invest because for the most part, if you had to pick 5 of these stocks out of the Russell 2000, probably not doing so well. But there are some high flyers that are going to be up 1,000%. Overall, I think QYLD is the best option for what I'm looking for. The NASDAQ has been the high flyer for the past decade, and as a result, it's fallen further, which has spiked the volatility, which pays out a higher dividend yield. The XYLD and RYLD are paying out very nice dividends as well, but I don't want to put all of my eggs into one basket by taking these type of stocks. So as of right now, between 5 and 10% is where I plan on keeping my shares and my percentage of QYLD going forward. And as the 12% dividend gets paid out monthly, that's going to go directly back into QYLD so I can continue to build up the amount of shares that I own. So let's talk about taxes because I think this is really important. I've been trying to do my best to, whenever I talk about a dividend, talk about what type of dividend it pays out because there are multiple kinds. Qualified dividends are just taxed as normal income. That's great. It's very simple. QYLD and Realty Income, ticker symbol O, are taxed as a return on capital or ROC. What this means is that you're not going to be paying taxes on it immediately. What it's going to do is it's going to lower your cost basis. So say I buy QYLD at $20 and it pays out a $1 dividend. That means going forward, my cost basis is going to be $19 and I don't have to pay the taxes on that until I end up selling the stock. This means that you can push off the tax date until when you want, or probably the best way to do it is to have this in a tax advantaged account. Stuff like a Roth IRA where all of your profits are going to be non-taxed is a great way to take advantage of a dividend stock like this. I do like the flexibility where you don't have to pay the taxes on the dividend immediately. You can plan on when is a good time to be paying your tax bill on a stock like this. So that's something to keep in mind. You're not going to have to pay taxes on it immediately, but eventually the IRS is going to want some of their money. Something to keep in mind is that the trend for the all-time chart for QYLD has been on the decline. It's down 19.7% overall. So as your cost base is going to be decreasing, the trend has been the QYLD is also going to be decreasing in value. QYLD gives a lot of flexibility where you can put the dividends and use it to pay bills. You can use it to buy other shares, or in my case, I'm going to continue to double down and buy more shares of QYLD as my portfolio grows to try to keep it between the 5% if the stock market is just chugging along and 10% like right now if things are going relatively flat or decreasing slightly. QYLD is not the type of stock that you're going to build your entire portfolio around because as I mentioned, all time it's down 19.7% overall, and that's not how we're going to be building long-term wealth. We're going to be picking stocks that are going to outperform the overall stock market in the long term and pay out very nice dividends that allow me to pay bills, buy different stocks, double down and reinvest those dividends into that same stock. It gives flexibility. So QYLD is going to be a part of my portfolio for the long term, but it's not going to be the keystone part of my portfolio that I'm going to be building wealth based off of. This is something that's going to hedge my portfolio as the market continues to slide and volatility continues to spike, because as volatility goes up, I'm going to be making more and more premium per month on QYLD. Right now it's sitting at around 12%. If the stock market continues to go down, that could spike up to 13%. Looking at its range, it's been as low as 5% and it's been as high as 26.95%. So there's a huge variability between how much QYLD is paying out in its dividend. And as of right now, it's very nice sitting where it is. And I'm very happy to hold it and see what happens with the overall market. So I'm very curious what you guys have to say about these high dividend instruments. They're not for everyone, but I like the ability to bring in a high dividend yield percentage and be able to reinvest it into something that's going to continue to bring in that high dividend amount. If the stock market does go up, I'm going to be happy because I still have 90% of my portfolio long in the overall market. And while this is something that will go up if the stock market goes up, it's not going to go up significantly because the covered calls are going to limit our upside potential, but it's going to allow me to benefit if the stock market continues to go flat. So I'm very curious to hear what you guys have to say about QYLD. Do you have a favorite between QYLD, RYLD, or XYLD? And I'm very curious to hear why. Thanks for watching this video. If you made it this far, I really appreciate it if you hit that like and subscribe button, as I'm trying to reach 10,000 subscribers and I need your help to do that. Thanks for watching. I appreciate all support and I will see you in the next video.